Shares of discount retailers Dollar Tree and Dollar General under pressure this week after the companies issued troubling guidance in their latest quarterly results. First, Dollar Tree on Wednesday announcing it would close nearly 1,000 Family Dollar stores over the next few years as it battles macroeconomic concerns and theft. Now, on the other hand, you have Dollar General on Thursday, which also warned of higher costs related to more costly labor and shrink. So what does all this mean for the playbook, and how do these companies turn things around? We want to bring in Kate McShane. She's Goldman Sachs' managing director covering the U.S. retail sector. Kate, it's great to have you here. So help us make sense of the trends that we're seeing at Dollar Tree and Dollar General, because I think many investors would think that these two names would be positioned to do extremely well at a time like this. So why are we seeing a bit of a disappointment when it comes to the forecast?
Well, I think we might have to start just what we've seen so far, which has been a more challenged top line and revenue growth for both retailers as they have experienced more pressure from the lower end consumer, which is their core customer. And so because of that, there has been pressure on the top line for them. The lower end consumer, while employed, has been dealing with high inflation and also reduced government benefits. And that has been one of the areas that both discount retailers have been dealing with, along with, on the cost side, quite a bit of shrink, which is basically loss of product from stealing and the like at the stores.
When you think about the average prices of just inventory at these stores, I mean, it feels like we're moving towards $3 tree, $4 tree, upwards of $7 tree. What, in terms of the consumer expectation and how the inventory is going to be moved through from Dollar Tree and Family Dollar's perspective, what is the real price that consumers should expect when they're going to a dollar store in 2024 now?
Yes, it really does depend. I mean, starting with Dollar Tree, which until very recently sold most of what it had for $1. It broke that buck, which is a term we use. They broke through the dollar a couple of years ago now and are at $1.25 for a lot of its product. But as you mentioned, they're also adding multi-price points as well. And that's in order to cater more to what their customers need. So there are $3, $4, and $5 price points, especially in bigger items that they can offer their customer. And I think as a result of offering that, Dollar Tree is seeing a higher end demographic by coming to their store. $125,000 demographic is now shopping at Dollar Tree more so than they were before.
Okay, well, what does that tell us then just about promotional environment, promotional activity that we are going to likely see here in the coming quarters?
I think from a promotional environment, what most retailers are talking about is a normalized promotional environment. So what that means is when people talk about normalized, they talk about levels going back to what we saw before the pandemic. I think, during the pandemic and post the pandemic, there was quite a bit of pullback in promotions just because there was such high demand. I think now that we're in a more normalized environment, the level of promotions that we're going to see across retail will look similar to what we saw before the pandemic.
When you hear about rewards program from some of the largest retailers, Walmart, Target, that in essence, for some of the deals that they might push through to some of the members of those rewards program could bring prices down for select items comparable to that of a Dollar Tree, a Dollar General. Where does that kind of net out? And does that just become a net benefit to a company in Walmart that has sheer scale that is multiples that of a Dollar Tree or Dollar General?
There's no question that they're all competitors to each other. And you're certainly right in that we have seen lower price points introduced. It's something that Target talked about at their analyst day last week, where they're focusing on more value price points. And that does get into, a more value range in terms of what they're offering, $5, $10, $20. And it does overlap with the discounters. So it is getting more competitive. The customer is looking for value. I think the customer is always looking for value, and you're seeing that focus from Walmart and Target, and then just the ongoing focus from the discounters as well.
So, Kate, who is the top pick then within the sector? And given the fact that we're going to get the Fed meeting next week, and we could hear some language that would point to the fact that we might not see a rate cut anytime soon.
Yes. Well, our top pick right now is Target. It's on the conviction list here at Goldman Sachs. The idea is that Target is lapping some very easy compares from last year. They had some challenges last year, in particular in the second quarter, and it's something that, as the consumer, we think gets a little bit healthier throughout 2024, we could see some resumption of discretionary sales for Target. It's not really dependent on rate cuts necessarily. I think Goldman Sachs' view when it comes to the health of the consumer is pretty solid because the consumer is employed. We are forecasting that the consumer's discretionary cash flow will increase by a low single-digit range this year.
Goldman Sachs Managing Director Kate McShane. Kate, thanks so much for taking the time here on this Friday. Really appreciate it.
Thank you for having me.